Let's get to the market master in. We welcome Saurabh Mukherjea of Ambit Capital. Good morning, Saurabh. You couldn't have come at a more opportune time. A lot of people have been calling for a sell in the market, a crack in the markets, both global and Indian. What is your sense? Do you think the initial honeymoon period is kind of over and now the markets will not be able to break their all-time highs, which are also near-term highs, anytime soon?
I think it has become fashionable, hasn't it, to become much more circumspect in the market, and that is likely. If you see a market running up from 18,500 to 25,500 in the space of 12 months, it's bound to lead to concern. Our sense is that whilst you're likely to see a lull in the optimism regarding India, because there seems to be a lull in policy making, I don't think the new government is making as much policy headway as many had expected it to. So whilst you're likely to see a lull in the markets, the economy does seem to be turning. I think the Q1 results does suggest a relatively decisive turn, albeit a slow turn in the economy. So with the economy moving towards 5.5% growth in the current fiscal, I think as we go towards the year end, you'll see a resumption in optimism regarding India. But I think it is relatively clear now that with the new government broadly getting out of its honeymoon period, some of the wild optimism, some of the sort of really effusive optimism regarding India is abating, and hence I think we're going back to our core investing psychology, investing methodology of good and clean. Buy clean companies to make money in this market, because I think optimism, the real wild optimism regarding India is abating relatively quickly.
That's a good thing, right? I mean, it's good to see some skeptics in the market. That's healthy, I guess,
absolutely,
after the run-up that we've seen. But, okay, so now you said the word buy. So what are you buying at this point? I noticed that you have Ipca Laboratories on your list, and that's a stock that's taken a big beating today. You're not worried about all the falsification talk?
I think obviously whenever the FDA comes up with serious observations on a company, analysts like us have to look at it in a great deal of detail. But I think what gives us comfort is a couple of things. This is an unusual pharma company. Less than 15% of revenues come from America. So it's not like, say, a Ranbaxy type situation where the company is heavily dependent on the US. So the fact that Ipca exports mostly to other emerging markets and sells in India rather than being dependent on America gives us a lot of comfort. So we just see today, I think Ipca is down on your screen. It seems to be down 3 or 4%. Overall, I think since the FDA announcement, the stock's down a good 15-20% for a company with less than 15% of revenues from America. So that gives me a lot of comfort that this is a good time to buy. The second thing is that I believe the management's been relatively clear from the day the announcement was made that these are relatively serious issues. I think they said to us right at the outset that there are quality control issues vis-a-vis the FDA, and there is a data integrity issue. I think they were very clear about that. And they took a voluntarily decision not to export anymore. The FDA didn't tell them to stop selling in America. Ipca took a voluntary decision not to export anymore. So I think there's been relatively good visibility from the company, less than 15% of revenues from America, good track record from the company, and I think this is a time to buy what is a compounder over many years. It's a 10, 15, 20-year compounder. And I think at these valuations, the ones that you're flashing on your screen, I would certainly be a buyer of Ipca.
Well, somebody clearly has thought that 660 is a good place to buy. That was the low it touched in early trades, first trades, and already 40 rupees up from its day's lows. So clearly some bottom is coming there. But no, let me come to the big guys first. I noticed that you cut your weight on intra E&C capital goods. The obvious name that comes to the mind is Larsen. Where are you on that? As well on the downstream infra companies, the pure power, the pure road guys.
So let me just take the bigger picture and I'll come on to Larsen. What we realized in our trips to Delhi over the last month or so is when in two critical sectors, power and in banking, we simply weren't seeing the sort of policy making that we were expecting to see. I don't think anybody expected rapid-fire decisions from the government, given the complexity of these sectors, but we were expecting to see a bit more homework, a bit more analysis getting done by the new government. We're not seeing that in power and banking, and that made us believe that whilst there will be reforms in India, the reforms might be a longer time coming. The reforms might come, say, a year out rather than in any time in the foreseeable future. That's what led us to do a first cut in cyclicals in 12 months. So we cut our weightage on EPC, industrials, construction, while still staying overweight on cyclicals. We cut our weight in specifically these sectors, construction, industrials, and the broader EPC space. Now in that context, we turned sellers on Larsen around a couple of months ago. We were buyers in Larsen right up to around 1400, 1500. But once it went through that, it just became illogical for us to stay with the buy on Larsen. And I think that broadly echoes my thinking on the country. I think there's been a degree of over-optimism in cyclicals. I think some of that will get checked back. It's not, Larsen is the sort of bellwether name, but even names like BHEL, a Crompton, a Siemens, an Alstom, even the TND names, the BTG names, there's been a degree of over-optimism. We simply don't see policy making responding quickly enough to justify those valuations. And I think we will see a pullback in those sectors.
I was coming to the even more downstream infrastructure companies, Tata Power, Rail Power, Adani Power, GMR, GVK, any of them. I mean, some of them are penny stocks. Maybe you don't even cover them.
I mean, in some of their cases, we don't look at them because there's just nothing to look at really anymore. There isn't really balance sheets of businesses they're left to look at.
Let me just add what the Reserve Bank has been coming with in terms of easier financing, especially what that came yesterday, almost seems to indicate a free purse string for some of these companies. They could get their loans refinanced into 20-year loans, 15-year loans, which will definitely reduce the leverage burden. So is there any immediate relief at all, or are there other bigger problems that make you avoid them?
I think what we'll see is, I think what you're seeing from the RBI is a double-edged sword. What the RBI is doing at one level is it's allowing the banks to roll over the debt so that the power companies don't keel over and die. But at the same time, when you speak to the bankers, it's relatively clear no bank really wants to stick its loans out, stick out fresh lending into power, infra and construction. What that will do is I think it will constrain growth going forward, because I haven't met too many banks who are happy to lend to power, infra, construction, fresh disbursals. But what you won't see is the existing loans being pulled back and the companies going
they'll be ruled over.
So the RBI is giving the power sector oxygen supply, but it's not giving them enough leeway to get up and start running.
Okay. I was very interested to notice that you've increased your weightage in consumer discretionary, so names like TTK Prestige, and in textiles, so names like Vardhaman Textiles, which have reported quite a weak set of numbers today. Just take us through your rationale and what are the key stocks you like there?
I think this is the flip side of us pulling back from industrials. So just as we believe that industrials got overextended, the optimism on industrials became a bit over the top, our sense was on consumer, people had become a bit too pessimistic. So we not only included TTK Prestige and Vardhaman, we also brought Marico into our model portfolio. I think that's the first time I can remember in 12 or 18 months that we've had 3 consumer names in the model portfolio. And simple logic is that we want well-run companies with good consistency in their management and their numbers over, say, 3, 4, 5 year period, and where we're looking for valuations to have come off. So Marico, I think, is trading at a 15-20% discount to the FMCG sector. Well-run company, has upped its dividend 6 months ago, and I think there's more prospects of dividend hikes from Marico. Vardhaman, I have to confess that whilst the near-term results disappointment is a weakness, what we like about Vardhaman is for a small-cap textile company in the Indian context, for a small-cap textile company, it is remarkably stably run. It seems to generate cash. It seems to not take on truckloads of debt. It's a relatively stable, well-run textiles company, and that is very, very rare in our country. So having seen that, we could not but put it in there. The results are a disappointment, but the company has delivered over a long period of time. The stock hasn't done much for a couple of years. So these are the sort of small caps I love. Good company, consistent generation of cash, and yet the market doesn't appreciate it. You buy them, this is where we typically get our 3-baggers, 4-baggers, 5-baggers over a couple of year period.
Okay, you wouldn't, I mean, we will be shortly speaking to the management of Jubilant Foodworks. The sales continue to dip quarter on quarter. You don't think it will turn around because the economy is?
I think, to be fair to Jubilant, I don't think they have done that much to trigger off this sort of sell-off. We've been sellers on Jubilant for 2 years, largely because the sell side took an extremely optimistic view as to how quickly Jubilant can grow. Consistently, I've seen that the sell side's same-store growth for Jubilant is ahead of management guidance. So I don't think management has done as much to warrant this sort of pullback. And our concern remains that Jubilant still remains overvalued. The market is in effect assuming that we will eat a heck of a lot of pizza. And whilst we all like to eat pizza, I don't think that we can eat the amount of pizza that the Jubilant numbers are factoring in. So to be fair to management, I don't think they are responsible for the sell-off. There are other factors out there.
Okay. Well, what are your top Nifty buys now?
So we are looking at names, PSU names such as ONGC, such as Coal India, where there is a policy imperative to dig more coal out of the ground. ONGC looks likely to move towards a disinvestment, and typically before disinvestments, these sorts of names do well. Outside the metals mining space, we would look at a name like HCL Tech, a consistent multi-year compounder for us, and largely staying with the core sectors. Bajaj Auto, I think Bajaj Auto is due a comeback. As the economy recovers, they'll come back.
Okay. All right. In fact, you know, Saurabh, if you want to stay on with us, we have the management of Jubilant Foodworks right here. So you can even ask the management questions in case you're interested and you do track the stock closely. So let's get Ajay Kaul into our discussion. Ajay, hi, good morning. In fact, you know, for the third quarter in a row, you've seen a same-store sales degrowth, and this time around it's coming at 2.4%. What's the prognosis from here on? Is this the bottom as far as SSS growth is concerned, or do you think it could get worse from here, as some of our analysts have pointed out?
Good morning to all of you. I think in terms of consumer sentiment, while we may have all the optimism in the world as an organization and me as an individual, I think the environment has kind of belied you know, that optimism, honestly. And we believe that sentiment is kind of continuing. What is coming out of the last 3 quarters, which you may argue may have been the bottommost point, I think that seemingly is continuing. So we're not seeing much change in that. Having said that, last year in Q2, without trying to give any guidance, you know, we had run one promotion which was like a breakthrough promotion. It was called One-on-One Wednesday, where our orders did kind of climb quite a bit. So in comparison to that, as and when results come in, you know, it probably will look a bit tougher. But at a consumer sentiment level, unfortunately, I must say that we are not seeing any change. When is it going to kind of turn around is a question which often gets asked. I think probably a couple of quarters still. And as we start coming against last year's numbers, which were not very good, you know, in comparison to what will happen, let's say, in October to December and let's say January to March, I think numbers on a relative scale, on a same-store basis, should start looking better. Consumer sentiment, I think, probably will take 6 months to change from here.
Okay, actually, Ajay, we have Saurabh Mukherjea, the CEO of Institutional Equities at Ambit Capital, also with us. You probably heard him speak about Jubilant's sales numbers as well. Saurabh, you're free to ask questions to Ajay.
Well, Ajay, good morning, and thanks for being willing to answer a question from me. So, simple question, sir. You are a powerhouse in the space that you occupy, and if you're finding sales difficult, if you're finding the consumer environment difficult, the demand environment difficult, your smaller competitors, I'm sure, will be struggling far more. Does this environment open up consolidation opportunities for a market leader such as yourself?
I would say, you know, too early in the life stage of the quick service industry. While there are such opportunities, and there are a lot of small players who are struggling. In fact, if you see the space, after probably we went IPO 3-4 years back, there are as many as 30-40 investments from private equity companies over the last, you know, 2-3 years that have happened. Small tranches, but I would still say a lot of activity happening. But most of them are struggling, and if the PE guys were wanting to exit, there could be some smart opportunities sitting there. But I think for the larger players, and we, you know, being the largest and the fastest growing player, we have been consolidating our market share and so on, even in tough years like this one. I think we are more focused right now as a company in ensuring that Domino's is back on track, no negative same-store growth, and very soon we want to get into the positive territory. Clearly, Dunkin', which is Dunkin' Donuts brand, which is responding quite well to the way we are trying to bring it into the marketplace to make sure that that kind of finds its place. So, rather than focusing on new consolidation opportunities by acquiring companies, I would say in the short, medium term, which is the next year and a half, we would rather get, you know, our basic brands, you know, back on track. I think at an industry level, there are other companies who probably may be interested in, but they're all too small to kind of right now look at consolidation.
Yeah. Ajay, actually, that was what I was going to ask you. You know, if you kept Dunkin' out, is just the Domino's product indicating that at least the worst is over? Are you even flattening out in terms of number of pizzas consumed in the same store?
No, I would put it like this. That's not the case. You see, any kind of research that we have done at an industry level, at a company level, and all other indicators basically say that consumers actually have gone back to home food. And there's a substantial number supporting that. Because we are at the fag end of discretionary spend, although you may argue the ticket size is small, if you look at one of our honorable opposition like McDonald's, which is what 25 rupee entry points, which ticket size is even far lower than ours. If you have seen their numbers also, they're far worse than ours, and that sometimes baffles me. But what I'm trying to say is the consumer sentiment is clearly, going towards reduced expenditure on these items, even if the ticket sizes are small. Research says that as many as 1/3 of the consumers are actually expressing that sentiment. We do believe that as the sentiment changes, we would also recoil and rebound that much more faster, and there is enough evidence in India and even internationally that such things do happen. Maybe that's the optimist in me which is making that statement, but I'm kind of confident that, and the team, that probably 6 months from now, there will be some positive signals which will start emerging from the market.
Okay. You would agree to that, Saurabh?
I think there's a fair point there. The consumer sentiment remains weak. The main areas where we are seeing improvement is more B2B, so steel production, cement production, coal production. I don't think there's as yet a big pickup in consumer numbers. That being said, if you look at, say, two-wheeler sales or passenger car sales, there seems to be early signs that the consumer is building up a bit of courage. But I think Ajay is right. It will take probably 6 more months for there to be a wholehearted consumer recovery in the country.
But the point that Ajay is making is also very interesting. It's not about competition anymore between a Domino's Pizza and a McDonald's and a Taco Bell. It's more about people moving out of this space and getting back to home food, as he suggested as well. So Ajay, I just wanted you to come in on, what this would mean in terms of your margins, because your margins currently are sitting at a 20-quarter low. And since on one hand you have competitive intensity, on the other hand you have raw material costs, etc., do you think it would make it very difficult for you to get back to those 17% margins that you used to enjoy?
See, two parts to the question. Getting back to 18.7 was the highest we did 5-7 quarters back. Getting back to those numbers will be very tough. I mean, I'll be honest with you. Because in those years we had same-store growth going up to 37% and so on. But, would margins, is there scope for margins to improve? The answer to that is very simple. If the inflation in the market is anything between 7-8%, we need at least 7-8% same-store growth to kind of offset most of the conventional cost increases, whether it is rental, whether it is to some extent labor, and so on and so forth. And if we were to get into a double-digit territory, which is like, let's say, 12-14%, is where margins would start climbing back. Is 10-15% same-store growth possible? Most certainly. I mean, I have no reason to doubt that probably in a year and a half, 2 years from now, we should be actually clocking a 10-15% same-store growth.
Okay. Well, all your cost overheads are higher. Raw material up 19%, employee cost 32%, rent cost 35%. Are all these because of store expansions? Are you getting any relief in terms of lower costs of rent in the existing store?
See, by virtue of being, thankfully the fastest and the largest, we are more than double the size of our next largest competitor. I mean, if you see the Euromonitor report, the latest one, we are 20% larger than, somebody as mighty as McDonald's. The point is that we are able to leverage this growth. I mean, we are still growing at 20-25% if you see. We are still able to leverage this growth with our vendors to not get the kind of, inflation which you see in the market. We get obviously much lower than that. We are able to leverage our fast expansion, 150 new Domino's stores, 25 new Dunkin' stores with our suppliers for our, stores to get our store construction costs down. So we do get a lot of those advantages. But having said that, a -2% growth, is something which puts pressure on our existing machinery. The new stores, of course, are growing, and that gives us economies of scale benefit. But till the point this number doesn't climb back to at least what the inflation is, it would put pressure on the bottom line.
All right, Ajay, we leave it at that. Thank you for joining us, and we hope you see the recovery that you've talked about, 10 to 15% same-store sales growth in the next 1 to 1.5 years. We hope sentiment picks up, and we thank Saurabh Mukherjea as well.
No, if you don't mind, can we keep Saurabh for a bit more? Saurabh, you started saying that the dips should give you the opportunity to buy boring stocks, and you started off with ONGC, Coal India. Tell us the other boring stocks that you will bet on first as the economy turns in the B2B segment.
So I think Bank of Baroda is another name we're looking at very carefully.
Literally B2B.
Yeah, I suppose, yeah, so nice play. And what's given us comfort in Bob is not just that the valuation is below book value, but it genuinely seems to have a better quality loan book than most other PSUs. The liability franchise is well known to be reasonably reliable, but the asset franchise, we believe, is more reliable than many believe it to be. Okay. And with Mr. Mundra finishing a stellar stint in Bob and moving to the RBI, we believe this is the right time to buy what is a relatively high quality PSU bank. I think the overall PSU bank space, a lot has been said about re-rating there and so on. I think reform will be slow to come here, but when it does come, a bank like Bob is better placed than most to benefit from it. We discussed ONGC, discussed Coal India. I would also go into the small cap space and look at boring names. So a company like VA Tech Wabag, it's not a well-known name which flashes up every day on your screens, but what it does is desalination and water purification. Across that whole belt stretching from the Middle East to Southeast Asia, there's growing requirement for these countries like Saudi are spending $2 billion a year on desal. In India, states like Gujarat and Tamil Nadu are spending heavily on desal. This is the only Indian company which has European quality technology because of the acquisition of Wabag 6-7 years ago. European quality technology, Indian standard EPC costs, growing order book, no leverage, high quality construction company, worth buying, I would say.
All right, as they say, wars will be fought over water in the near term, not over
for
oil.
All you know, this is going to sell more than any other product in India. And
we have actually a query that's posted on our Money Control message board, so I'm going to quickly just ask you the question. Rohit Jain has written to us from Kolkata, and he wants to know if Tata Motors could see a rebound by next week. So I guess it's a trading question that he's asking us. But in any case, what's your view on Tata Motors?
And do expand it to the entire automobile space, since you referred to the improvement in two-wheeler sales.
I mean, look, honestly, I have no idea what will happen by next week. I wish I knew. Our view on Tata Motors has been a buy. We remain buyers of the company. But we also admit that this is more a story about China and JLR. So JLR is as a global play and China as a specific market than it is about India. Could there be a CV upturn in India? I think a CV upturn in India seems to be happening. All the SIAM data suggests there's a CV upturn in India. But TAMO is now so dominated by JLR that its link to an Indian recovery is relatively weak, I have to confess. So we remain buyers, but it's not got that much to do with the Indian economy anymore. More generally in auto, in two-wheelers, our favorite play remains TVS Motors. We've been pushing that for a good year or so. I think there's plenty of headroom for TVS to grow. In tires, Balkrishna Industries remains our play. It's an export-centric play, and I think Balkrishna again has lots of headroom.
Right, that's plenty of stocks to ruminate over. Thank you very much, Saurabh, for staying with us for this long.